Now you can hear me, Ryan? Yes. I'll start again. Good morning, everyone. I'd like to welcome you all to the Daily Energy Markets podcast. I'm delighted today to be joined by Kate Durian, MEIS contributing editor and non-resident fellow at the Arab Gulf States Institute in Washington, Matthew Wright, senior freight analyst at Kepler, and Scott Livermore, chief economist at Oxford Economics Middle East. Thanks, everybody, for joining us today. Kate, good morning. Let me start with you. We've talked a lot about geopolitics this week on the show, and of course, it's dominating front and center, isn't it? With the daily headlines, awful headlines that we're seeing there and images in front of us. But the one thing that isn't being rocked is the oil price that much, and you know the disruption to even flows that we saw a couple of weeks ago with the geopolitical situation in the Middle East seems to have also dissipated. A disruption meaning more redirection via Red Sea, etc. Where are we today in terms of that physicality of the oil markets? Everything seems very calm.
Everything is calm. The market is sort of relatively balanced. Everybody's waiting to see what the OPEC Plus will do on June 1. And the likelihood is that they will keep the cuts in place. I think initially the market was going up because people thought that this war might escalate. But I mean, you look at what's coming out of Iran. I mean, they're proving themselves to be a sort of paper tiger. They really don't want an all-out war because if you've seen the satellite pictures, there was damage that they didn't really want to admit to. So I think we've seen 7 months on, you can see that nobody really wants to escalate this war. So I think geopolitics isn't really playing that much of a role anymore. I think people are looking more at, U.S. stocks, gasoline, diesel demand in the U.S., Chinese growth. There's a lot of ifs and buts, if interest rates are raised, if Chinese demand comes in lower. So I think that's where we're at the moment, which is why the market isn't really moving. There isn't that much volatility at the moment.
Yeah, Scott, welcome. Give us your view on that. Nothing's moving at the moment because of all this uncertainty. What is going to happen with U.S. Fed rates? With China demand, etc. We're kind of stuck, aren't we? And what do you see, if anything, moving that dial, if you like? Let's put geopolitics aside. On the fundamentals, on demand, on economies, are we set for the rest of the year?
Yeah, I think the outlook's relatively stable. Aside from geopolitical politics, it's been highlighted by the IMF and they're in the region that geopolitics is the big risk. I think if you look at the US, data's coming out relatively robust, but not too robust. So the labour market was looking a bit better, offsetting some of the impact of higher inflation that we've seen so far this year. So while the Fed's not likely to act quickly, and certainly not like the markets were expecting at the beginning of the year, our forecast is for the first move in September and 25 to 50 basis points of cuts during the course of the year. It's unlikely that the data are so strong that the hawks will prevail and talk of higher rates probably off the table. Similarly in China, Q1 was better than we expected on GDP level. But that was kind of driven by production more than demand. So there's a risk of a stock build up. So it's not clear that it's going to last at a significant pace. And I think abstracting from the geopolitics, we're looking sideways really on oil prices and oil market. Relative stability on the fundamental front.
Okay, all stable, although uncertain. Matthew, good morning again. I just want to touch on the point that we started on with Kate, which is the sort of geopolitics, but the lack of sort of, I suppose, hostilities across the Red Sea, Bab el-Mandab area. Ever since we saw the skirmishes between Israel and Iran 2 weeks ago or so, haven't seen much action from the Houthis, at least reported. What's that doing to rates, to shipping sentiment, etc., and forecasting?
Yeah, good morning. Thanks for having me on. So yeah, I agree. I agree with Kate and Scott. I think the fact that the market really is looking to not escalate the situation, and we've seen essentially as much disruption to shipping as you're going to see in terms of diversions around the Strait of Bab el-Mandeb Strait. That's already been baked in from a freight point of view, and then from an oil price point of view. When you look at it from a the crude oil balance, we've actually been in a period of surplus for a couple of months, and yet the geopolitical premium is what's been sort of holding the market up. We're now entering from May onwards. We're sort of entering now a bit of a drawdown period, and that is another reason why Kate alluded to the OPEC cuts likely to be pushed over from June. We expect them to be extended definitely throughout the end of the year. It's in their interest just to from all parties now to try to come to some sort of resolution in terms of the situation in Israel. But from a market point of view, we're not really seeing any more disruption from the high level of disruption that we're already at.
Okay, thanks, Matthew. Kate, I mean, back to you about OPEC. So, like you said, and like the majority in the market have been commenting the last 2-3 weeks, that these cuts are certainly going to be extended through Q3, and then we'll see. But the other topic of conversation that is expected to happen at the June meeting in less than a month now is the quotas, etc., that was sort of firmly on the agenda then. Is that going to perhaps be taken off the table, given that we're not talking about changing volumes anytime soon?
I don't think it's going to be off the table because they have to do it. They've had this independent assessment of capacities. UAE recently didn't really announce it, but you look at their website and suddenly they're at 4.85 million barrels a day, which is close to their 5 million target. And if you look at their production, I mean, they're sitting on over 1 million of spare production capacity, and I'm sure they're not very happy with that. So that may become an issue. We've also got the other issue. If you see the Iran issue, Iran exports through Malaysia, the Americans now saying, hang on a second, this has to stop. Whether Biden will do something, because they haven't really been monitoring the sanctions busting by Iran for a while, pre-election, is he going to show that he's getting tougher on Iran? Prices at the moment, I suppose he can afford to. So I think there's a lot of, there's a lot of issues, but you also at the same time, they don't want more defections. Angola quit because they were upset at their lower quota, the assessment of their capacity. Now we're seeing Angola pushing out more oil, selling more to China, to Asia. I think India is taking more. But anyway, it's I don't think they're going to push it. I think they'll discuss it. Whether they agree on anything is still up in the air. It won't happen until January next year, I think.
Okay, well, that picture has certainly changed, hasn't it, from 2-3 months ago? Scott, just back to you. Let's talk a bit about just Russia from not so much a geopolitical angle, but again, we have a headline today on our bulletin about Russia launching a wave of attacks on Ukrainian infrastructure in its recent incursion, I suppose. And of course, we had the opposite for a while on Russian refineries. Then we saw the US aid package approved, and we saw that not stop, but perhaps calm down a bit. From an economic point of view, how is Russia doing in terms of the sanctions on it? Its continuous war. Everybody's concluding right now that this war is not going to end this year or next. From an oil market point of view as well, are we settled into a completely new normal, and we don't expect any further impact from sort of new sanctions, etc.?
Well, so Russia's economy is pretty closed off as it is, and certainly from Europe and the US's perspective. The economy is faring relatively well. It's a war economy now, so everything's been moved to producing and turning manufacturing to support the war effort. And that's leading to quite a lot of stimulus for the economy. Why it can continue to have relationships with parts of the world, whether it's China, whether it's kind of India, and can kind of trade, then it's probably in a position where it can sustain its position and the effort for a while yet. I don't think it's on the edge of collapse or on the edge of economics forcing a reversal to the military operations. So that's likely to continue, and as the economy does well, then the population somewhat supports the efforts despite the losses. I think in terms of how it affects the oil market, the same channels are going to remain open. So the Russian oil is going to continue to be bought by the Chinese at a discount, and that situation I don't think is going to reverse itself over the rest of this year, even into 2025.
Okay, thanks, Scott. Matt, just to talk a bit about the US again and demand, the US economy, we touched on it earlier, but we have a headline again on our bulletin today saying how gasoline and diesel have hit seasonal lows, not since COVID. So we're going into the gasoline season, obviously, not just in the US, but elsewhere, travel season in Europe. Diesel, admittedly, more linked to manufacturing demand. But is that a surprise, that statistic, new lows since COVID? And, does that is that in tandem with everything else, considering that the seasonal factors?
Yeah, it's somewhat surprising, but I think if you look at pump prices in the US, they've been rising this year, and we were expecting them to sort of rise a bit further this year I think we're expecting about 6.5% year on year, which will have a material impact on demand. Obviously the elasticity of demand in the US is somewhat different to other countries, but this is definitely a concern. And from a freight point of view, it could impact the amount of gasoline that flows into the country from Europe, which will affect clean tanker demand. It's definitely something that is it's the main factor affecting core inflation, I think, energy prices and particularly gasoline and diesel. So it's definitely something they're going to want to Biden is going to be concerned about heading into later this year.
Okay, I mean, Kate, do you think that on the Biden front and election, obviously that is now front and center in everything that the US does, including what's happening here in the region. Kate, SPR, we have a headline again on, an article saying, oh, we reserve the right to use our SPR again, should gasoline prices get out of control. Things are steady for now, but from a sort of strategic point of view, is that effective? Do you think the market will respond if it is used, given the fundamental situation?
It depends. It depends on whether it's being used to try to bring down the price even further. I don't think it makes much difference. I don't think it has in the past. It just tends to harden the position of Saudi Arabia and the rest of OPEC, because they were pretty upset when the US did it the last time. But I was just reading in the FT, there's an article basically saying, look at the United States. Everybody's saying, oh, Biden was bad for the oil industry, for the fossil fuel industry. But look at where we are now. We're producing at record. The US is the biggest producer of oil in history now. So I think it doesn't really make much difference in this market. And, it depends on whose demand figures you're looking at. Are you looking at OPEC's demand projections of 2.23 million barrels a day this year? Or are you looking at the IEA's 1.3? Are you looking at the EIA's 1.6, whatever it is? So I think it's
do you think we'll see OPEC adjust? Yeah, do you think we'll see OPEC finally adjust those demand figures now for the as we enter this second half of the year almost? That this diversion between those agencies for different reasons, obviously, but will we see those numbers come together, do you think, in the next forecasts?
I don't know. I think we'll know in the next couple of days, but I doubt it. I doubt even if they do adjust them, I don't think they'll adjust them by that much, so that, you'll still have this big gap in the demand forecast. But again, if you see China, at 5.2, whatever it is that the growth numbers are, they've come in higher than expected, then I doubt that they will. And let's not forget, even the IEA says that one of the biggest demand growth areas is going to be the Middle East. We're entering the period now where I switch on the hot water and it's hotter than the cold water. Yes. Is hotter than the hot water. So, we are entering this high demand season. We're still using, in some countries, a lot of oil and liquids for power generation. So I think unlikely that we will see, unless anything happens to sort of curb supplies, then you might see an SPR release, you might see a spike in prices. But at the end of the day, if you look at what happened in Saudi Arabia and what all the what Aramco was saying and what some of the oil companies were saying, and Exxon, basically they don't think that oil is on borrowed time. So I think you're looking at a period where they still expect growth for oil demand, not just now,
Yeah.
but they don't believe the peak oil theories, peak demand theory.
Yeah.
So
And hence trying to maintain, Scott, a healthy price for that oil as much as possible in that period, next 10 years or whatever you would want to believe it will be peak oil. I mean, on that point, Scott, and Saudi budgets, expenditures, etc. You've got obviously. We've had some news in the last few weeks about it paring back on certain projects on this big Vision 2030 non-oil sector, investment. But I mean, and given that oil prices are okay, but I mean, is Saudi in a comfortable position right now? Do you think it would welcome a higher oil price, or would this be a safer play for it, given demand impact, etc.? But taking into consideration its expenditure plans, and where do you see those going?
Yeah, but I think clearly it would like a higher oil price. It'd be more
but that could impact demand, couldn't it, very quickly? So
slightly, but especially if you had a stronger market, it could kind of reverse some of its voluntary cuts. So I think on the whole, Saudi would prefer an oil market, a stronger oil market, high oil prices. But I'd probably say that's more to maximize the value of its oil wealth rather than it's in financial strains at the moment. I know we've just got Q1 deficit, the sixth budget deficit in a quarter, and we're expecting Saudi to have a budget deficit of, say, 3% of GDP this year. So different to what we've been accustomed to, and somewhat surprising in an $80 plus world. But 3% of GDP is not a big deficit. And you've got to remember, Saudi Arabia doesn't have a significant build-up of government debt. And it's still got relatively good credit ratings, it can access markets. So it can fund and it can borrow and it can grow. So the budget deficit, oil production, oil price together is not constraining Saudi Arabia, certainly not over the next couple of years. I think clearly some of the news we've heard about things being pushed back, I think that's more to do with implementation challenges. Big ambitions have to be financed. I think they can solid financing, but they also have to be realized, and you can only move so quickly, whether it's construction capacity, absorptive capacity, labor capacity. And I think that kind of evaluation about what can be done well in the time allotted is the main reason things are being pushed back, rather than any significant financing concerns.
Okay, interesting. Matthew, let's talk a bit about LNG, because we tend to kind of like leave that in the background sometimes. We're talking about oil all the time, and but LNG carriers and ships can also be disrupted, and they have been obviously in the last few months to an extent. But gas prices have also been comfortably low, and someone saying that it's basically they could be at this is the all-time low, and then we're going to actually see an increase from now on, regardless. But again, any disruptions to LNG? Give us the Russia LNG perspective, what that looks like today, US LNG, etc. flows, and how Europe, I suppose, is looking at that market as we go into summer.
Yeah, absolutely. And LNG is one of those markets that I think sort of sidestep the whole Red Sea issue compared to the oil markets. Partly just because those flows were not directly impacted to the same extent that they are for crude and refined products. Every single LNG carrier, there was no LNG carriers in the Red Sea for a huge period of time. And that, there's far fewer compared to oil tankers. So it wasn't as dramatic a change. But that has just not had an impact. In fact, freight rates declined across a number of markets. We didn't see, and as you mentioned, gas prices, LNG prices fell. So this is a market that from the geopolitical side has just really not had that much of an impact because we're not seeing the same logistical constraints. We're now in a period where we're obviously well past the winter demand. We're heading now into sort of summer stock building, and over the last 2 summers, we've seen that Europe has been very capable of resupplying without Russia and getting well above the threshold required to sort of enter that period. So it looks we're in a fairly healthy state again. So I think it's from a end user point of view, we're in a fairly good position for the next 12 months or so.
Okay. Thanks, Matt. There's our question for today. Oil prices would hold in this quite broad range, but $15 range, which they've been in for the last few months, for the remainder of the whole year, given the now negligible risk premium, according to many people, and OPEC Plus keeping volumes steady. Do you agree or disagree? So we're going to see this range hold steady. The long-term outlook by some analysts is that oil is on the way up because it's relatively cheap, but we're not going anywhere for a while. So agree or disagree. Kate, I just wanted to talk a bit about, I know you're based here, obviously, in the Middle East, but just to talk a bit about Europe, because and European economy sentiment, because that is one of your other bases, of course, in previous years in Paris and London, etc. The economic sentiment there, in terms of energy prices, obviously is okay at the moment, but also we just saw Sweden announce a rate cut yesterday, and the whole question now is the ECB going to do the same, i.e., act before the Fed? So how, from a Europe economy point of view, what are the murmurings you're hearing in terms of how Germany's doing, manufacturing, etc.? Are we at the beginning of a slight silver lining here?
I don't think so, because I think, in the old days, you would expect Germany to lift the European economy, but that's not happening at the moment. And I think generally we're going to see interest rates higher for longer in Europe. I think they're going to be a lot more cautious, even if the US does raise interest rates later this year. I don't think Europe is out of the woods yet. I don't think we're going to see a surge in demand. I think Europe is still in trouble, and don't forget we're also in election mode. Look at what's happening in the UK. I mean, who knows who's going to come in next? We're seeing a rollback of some of the climate policies. So I don't see an impetus. And as I said, Germany is no longer the main driver of the European economy. But
you're seeing a rollback in climate commitments on the government front, perhaps as well, like in Scotland, for example. But what about the companies? What about the IOCs? What about this? What do you make of this headline on Shell earlier this week, being caught out at claiming that it had sold carbon credits that it didn't actually physically take care of, if you like, on the ground? What's the fallout of that, something like that, on other companies that are obviously taking similar measures, but also in the context of the fact that some of them have started to retract a bit from those commitments, right, to go greener?
Yeah, because if you listen to, say, the CEO of Total Energies, he says, you just can't do it. You can't go into hydrogen at current prices. It just doesn't work for us, and you need the oil revenues in order to drive the transition. But yeah, the Canadian the carbon credits issue by Shell is an indication that you do need a more a standardized, a global carbon market. It works in Europe, but outside it doesn't so much. And I think that's something that's going to be discussed at the next COP29. That's Article 6. So you have to regularize the carbon market. You do need to have a price on carbon. There's a lot of greenwashing at the moment. So I think that's what needs to be tackled.
Thanks, Kate. Scott, just let's talk a bit about emerging markets. South Asia, for example, in terms from a demand point of view, and you touched on China earlier, but the slightly poorer nations, if you like, in South Asia, those that are exposed obviously to the dollar value and the strength of the dollar, and being obviously importers of energy. Again, we're in this $80 kind of range. Comfortable for those emerging markets? What does that indicate for their growth going forward, etc.? Asia, I'm talking about other Asian economies.
Yeah, so cautiously optimistic. If we start with the big Asian economy, India is having a slightly weaker year, but still 6% plus growth. I think we're seeing a situation where inflation's edging back in India. The RBI is likely to cut interest rates, which is going to be supportive. In election mode in India, likely have continuity with Modi staying as the leader, and that's likely to mean that policy continues to support investment and development of the Indian economy. And we're probably in a situation where growth will accelerate again next year in India. In Southeast Asia, again, cautiously optimistic. Malaysia, Thailand, Singapore should all perform relatively well. Whether oil in $80 a barrel territory, we've been there a while, so we've kind of got used to that, and the kind of the inflation impact is passing through, and across the world, and certainly in these countries, inflation normalizes, frees the hand a little bit of central banks, relieves pressures on households, and all things that should support bottom line growth.
Yeah, I mean, certainly inflation also in those, well, apart from countries like Pakistan, but in other areas of Asia, it's relatively under control. Thanks, Scott. Matt, just to go to you for the last comments, let's talk a bit about refining margins. I mean, I know you're not specifically focusing on that, but I mean, that those have been under some stress, could receive some support, as we go into summer. But I mean, also just if we can address the extra capacity that's coming online in the Middle East, in Asia, in certain countries, is that in terms of short-term impact on market, on demand? Are we seeing anything? The Kuwait refinery that came on board online earlier this year with extra capacity, are those kicking in, if you like, to actual fundamentals in this quarter?
Yeah, and I think this year is a really crucial year. This year and moving into next year are really crucial for that additional capacity. Like you said, a lot of the Middle East refiners, came online, and it's been sort of a slow ramp up. And this year we now have Dangote, which again is going to be a slow one. I think we don't expect it really to be online until Q4, if not first quarter of next year. We've got Dos Bocas, which is again more the end of it. But all of it, the collective impact is going to be a significant increase in refined products availability, but also in areas of crude production, which is really significant because I think we're going to see a massive decrease in crude on water, crude exports, and an increase in refined products exports from all of these locations. It's really turning the screw on those European refiners who are going to, particularly some of the more simple setups across Europe, are going to really struggle to sort of break even amid this just glut of much more efficient running refineries. So yeah, it's going to change freight markets because we're having a shift to clean products, and by this time next year we should have a bunch of new refineries running at full capacity. Okay.
And I mean, Matt, I want to stay with you just on freight, but let's look quickly at that result. Okay, so that's a pretty resounding yes there, that they will stay in that range. Matt, just to ask you about freight, I mean, in terms of any indications we're getting on container freight rates from China to the US, which would indicate, obviously US demand for Chinese goods, etc. Has that flipped at all in the last couple of months, and forecasting for that? I mean, with the US economy looking quite rosy, and obviously that's good news for China as well in terms of manufacturing.
Yeah, I don't look at container freight a lot, unfortunately, but the last time I looked at it, the market had, obviously the Red Sea was very significant impact on container freight more than anything else, because a lot of those owners were just far more risk averse than some of the oil traders. That has come down, but it's still, that is still baked in. Those longer voyages for containers are just going to continue. So I haven't looked at the rates recently, but yeah, there was a big premium in the market.
Yeah. Kate, I'd like to go back to you to close for us, please. And let's talk a bit about geopolitics, and with your seasoned experience in the region on that. I mean, these signals that we've been getting this week, and again, I mean, obviously that all has an impact ultimately on economy and confidence and uncertainty. But do you have a clear reading of whether we are likely to see, we've had a few surveys this week on, will we see a ceasefire? Is this the beginning or the end of the conflict, if you like? Where would you put your money on today that we're going to see, with the added pressure overnight, the US now saying it will stop arms sales to Israel for the time being, even not just one shipment? That won't last probably, but do you see the dynamic changing on this Gaza situation? Are we going to see an end to it soon because of US
I don't really think so, I don't really think so, because if you look at the Israeli government, it's a very hardline government. I don't think you can negotiate with them. And also Hamas is being, they're agreeing a ceasefire, but, the terms that they're offering are not acceptable. But I think a lot of people have said, you really cannot deal with this Israeli very hardline government. They're going into Rafah, bits and pieces. There have been a lot of casualties, and I don't think it's likely. I covered the Iran-Iraq war when I was at the Associated Press many, many moons ago. And you know how many ceasefires were announced and broken? It's in the hundreds. I mean, every day there were claims and counterclaims. And so I think, talk of a ceasefire is not a reason to, talk the price up or down. I think you just have to see it on the ground. But I'm not very hopeful, not with the hardened positions of both sides, actually.
Yeah, and certainly the oil market is interpreting that nothing is changing, isn't it? It all looks pretty steady as she goes, and it's not reacting to these headlines either. Thanks so much to Kate and to Matthew and to Scott for joining us today, and have a great day, everybody. All the best.
Thank you. Bye.
Thanks. Bye.
Bye.